Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, you've been traveling a lot. Where have you been lately?
All over, actually. Yeah. Well, mainly still West Coast, North America, but Cabo had a Vegas trip in there, and then last week was up in Seattle, Washington for a beautiful wedding. Wife's sorority sister, big old celebration right on the water, and it was hot, 90 degrees. We've been getting a heat wave here on the west. I know even where I'm at now, back home, triple digits, which is pretty unique for us. So it's been a hot one. Here it's a little cooler back there for you.
Yeah, so you look tan. I'm getting ready for my, winter pallor.
Yeah, yeah.
Getting pale again for the winter. But anyway, we're glad to see all of you again this week. We took last week off due to the short week. It was a short week for the holiday and a slow news week, and we just didn't want to keep saying the same things. But this week we have a lot of really interesting content. There was a lot going on last week that we're excited to talk to you about.
Yeah, I was saying with the way the market, I thought you were looking pale because of the way the market performed last week. And I'm wondering, is there any correlation between us not doing the five things and all the craziness that it seemed to be going on throughout the week? Luckily, I was a little bit distracted, but when I checked in on Friday, it was a lot of red.
No, it's definitely not our fault. We did not cause the market decline. I'll also point out the obvious, which is DKI subscribers are heavily hedged. So when the market is down like this, we are outperforming by a huge margin. One of the things that we tell our investors to do is to protect their portfolios, to be prepared for the kind of volatility that we've had lately. There's been so much going on in the chip space, the tech space, the AI market, tons of concern about the Fed, inflation, interest rates, and obviously the ever changing employment numbers. With all of that uncertainty, we've been heavily hedged. And so, I think I read earlier today that today we had the first up day since August 30th. But when the market is down big, like it has been the last couple of weeks, we tend to outperform pretty well during those times.
Gary, this week we've got what we're calling the AI chip issue. We're talking Nvidia, Intel, DKR portfolio company, Las Vegas Sands makes an appearance. Talking Japanese government again, as well as some Nike with our friends from over at Learn Wall Street, which we'll talk about a little bit later. Ready to get into it, Gary?
Let's go.
Thing number one, we're talking Nvidia. Nvidia's rise to Cisco 2.0, boom or bust.
All right. So, one of the things that people have done over the last couple of years is they've compared NVIDIA to Cisco from the late 90s. And the reason they're doing that is it's kind of the pick and shovels play. What that refers to was back in the 1800s, the big California gold rush, when so many people headed out west to, try to mine gold and make their fortune. And many and most of those prospectors didn't make any money doing that. A lot of them lost money. But the people who reliably made money were the people selling picks and shovels and Levi's blue jeans to the miners. Back in the 90s, Cisco was selling computer servers to all of the big new .com companies. And that was a very fast growing, profitable business. They were kind of the picks and shovels play of the .com boom back in the late 90s. Over the last couple of years, NVIDIA has been the picks and shovel play of the AI, the artificial intelligence space, selling the best graphics processing chips, which are ideal for these AI applications. Now, one of the things that Cisco did back in the 90s that looked great, but got them in a lot of trouble was they did a lot of vendor financing. And so what that meant was they would go to their customers and they would say, hey, you want to buy a bunch of our servers? Okay, great. It's going to be $10 million or $50 million or, however much they were charging. And Cisco would say, well, don't worry if you don't have the money, because back then the money was all fake anyway. It was all of these companies had insane stock market valuations. And so Cisco would basically just give these companies a credit, um, book book this as revenue and give the companies their servers. And they call this vendor financing, and it was great because they were able to keep booking sales. The problem was when those .com companies went out of business, Cisco didn't get paid back, and it was a huge problem for the company. Now, there's been a lot of discussion that Nvidia is doing the same kind of thing, and the answer is yeah, sort of, but with a big difference. So last week, CoreWeave, that's one of Nvidia's big customers, secured a $2.3 billion debt facility in order to buy Nvidia GPUs. And so that sounds like the same kind of thing that Cisco was doing about 30 years ago, 25 years ago, something like that. But in this case, the funding came from Blackstone and Magnetar, not from NVIDIA. So unlike Cisco, NVIDIA gets to keep the huge sales increases, but they're outsourcing the repayment risk. It's actually a pretty strong move by NVIDIA. It's something that if you're an NVIDIA investor, you'd want to see.
What do you see, Gary, that is different between NVIDIA here in 2024 and Cisco in the late 90s, if anything?
So a lot of people, we've talked about this one before, Rob. A lot of people make that comparison, the picks and shovels comparison between Cisco back about 25, 30 years ago and NVIDIA now. And, I get it, I understand it, but I think there's a huge difference. And the difference is back in the 90s, a huge chunk of Cisco's customers were basically pre-bankrupt dot-com companies. Back then everybody was selling dollars for 90 cents to grow revenue. They didn't have a business model. They just cared about eyeballs. They just wanted to get eyes on things and figuring once we build enough volume, we'll make money. And that worked for a few companies, but most of them went bankrupt. They went out of business. And it was a huge problem. NVIDIA gets more than 50% of its revenue from 5 customers, but those are companies like Microsoft and Apple and Google. And, NVIDIA is largely selling to mega cap, fast growth tech companies with fortress like balance sheets. These are all companies with huge amounts of free cash flow, tons of cash on the balance sheet. In this case, the probability that one of NVIDIA's customers, one of their big customers, goes bankrupt is approaching zero. Nothing zero, but it actually looks really good for them. The biggest risk I see for NVIDIA is a little bit different. It's that one of those big 5 customers might decide, hey, we're spending tens of billions of dollars a year on AI. We don't really have a business model. We don't know how we're going to make profits from this. And if they were to slow their purchases from NVIDIA by just a little bit, that's going to crash the growth rate. And, NVIDIA has been growing more than 100%. This year, they're supposed to grow about revenue about 100%, slightly less. So any slowdown from one of those 5 customers who aren't making money from AI would be a big deal to NVIDIA's stock valuation, but the whole company isn't at risk here like it was with Cisco, back in the 90s. So I think NVIDIA is in better shape than Cisco. I understand the comparison. It's not one that I particularly favor.
Let us know what you think in the comments. Can NVIDIA maintain their lead? Do we see a Cisco 2.0 scenario? Gary, thing number 2, we're moving to Intel. Intel's comeback, the Core Ultra revival.
So we've been negative on Intel the past couple of weeks. They've had a massive problem with their 13th and 14th generation i7 and i9 processors. That's the high end of their consumer line. It's what you'd put in a really strong desktop or a gaming laptop. And they've had massive reliability problems. They're also facing competition from Qualcomm that makes something called ARM processors. The Intel and AMD processors work on the x86 architecture. Qualcomm is the ARM architecture. It's their ARM processors. And the reason Qualcomm is such a threat is because their chips have been optimized for mobile things like cell phones. And so they have really long battery life and, they're fast and good at handling graphics. However, in the case of Intel, they've just come out with something that looks fantastic. Intel earlier this year, came out with their Core Ultra line, and those were basically designed to be a combination of CPU, your central processing unit, and a GPU, your graphics processing unit. And in this case, Intel has just announced the specs on their 2nd generation Core Ultra line. That's going to start coming out. You'll start seeing those in stores in the next couple of months. And the specs on this, if they turn out to be real, are unbelievable. It's their Core Ultra 200V line. Uh, these processors supposedly have 20% better performance per watt compared to Qualcomm Snapdragon chips. They use 50% less power, 50% less power than the predecessor chip. That's the Intel chip. So what we're going to be seeing, hopefully, are new laptops where you could have a battery life in the 15 to 20 hour range, similar to using a cell phone. A typical laptop now gets about 5 hours, maybe 8 if you're using it, light and keep the screen dim. So we're looking at somewhere in the neighborhood of a tripling of battery life. And the big thing now from Microsoft, they have their Copilot Plus designation. And for something like that, they refer to an NPU. It's their neural processing unit. And I forget the number, Rob, but I think it's you need 40 or 45 trillion operations per second, which is a jaw-dropping number. The new Intel chips handle 48 trillion operations per second. So basically what that means is if these things work as well as Intel says they do, and when they come out, you will be able to handle AI applications on your laptop. The reason that's a big deal is right now most people have to use cloud-based applications, and that's fine as long as you're not doing anything that's too sensitive. In the case of a lot of AI applications, though, you're showing those large language models, you're showing the AI model your internal data, your personal or professional, your corporate data. And a lot of people don't want to do that. And I understand. I'm a big believer in privacy. I'm a huge advocate for people's privacy. So the ability for these new Core Ultra chips to handle AI applications on your laptop or on your computer, I think is just a difference maker in terms of privacy, being able to do it yourself instead of having to send all your data, through the internet to the cloud and have it on somebody else's server.
The battery piece sounds good enough for me. I'm the culprit, always sitting on 2-3%, it seems like. But Gary, if next year's i7, i9 processors solve some of these burnout problems we've talked about, do you think this could be Intel's big comeback moment?
I think it is a big deal. I think these Core Ultra processors are designed to one, handle the cost of people buying laptops where you have to have a CPU and a GPU. Now, if I were to buy one, I probably would want an Nvidia graphics card in there as well, but that's kind of a belt and suspenders sort of thing. So being able to have it on one processor instead of needing to buy a separate Nvidia GPU, I think will save people some money. I think people like the better battery life. The alternative is they could use a smaller battery and maybe take some weight off of the computer. That's kind of a big deal in the laptop market. I know my laptop, which I like a lot, and has both an Intel processor and an NVIDIA GPU in it. It's heavy. It weighs more than 4 pounds, and I travel a lot. It's the kind of
Yeah.
thing that enough electronics in your bag, enough chargers, it'll make your bag pretty heavy when you're carrying it through half a dozen airports on a trip. So, I think something like this could be a good deal. I've also heard some good things about Intel's next generation i7 and i9 processors. I'm hoping they manage to solve the reliability problems. The other thing, and I'm not sure whether this is a good idea or not, I'm interested in your view. If you guys have a view on this, put it in the comments. But Intel announced recently that they're going to outsource manufacturing of their 3 nanometer and below chips to Taiwan Semiconductor. Now, in one sense, that makes sense. Taiwan Semi is without question the best, semiconductor manufacturer in the world. But, Intel for forever has been, an integrated shop where they would design the processors and produce them.
Mhm.
It's very clear they feel like they can no longer compete on the foundry side of things. And, we'll see. We'll see if that's the right call or not.
Thing number three, Gary, we're going to be talking Las Vegas Sands, ticker LVS, one of DKI portfolio positions. Gary, thing number three, we've got Macau summer tourism rebounds.
All right. So Las Vegas Sands has the leading market share in two different markets. They own half the Singapore market, and the Singapore market is roughly the same size as Las Vegas. So the Marina Bay Sands there, imagine owning like the north side of the Las Vegas Strip. It's kind of like that. Macau is the gaming capital of the world. It is part of China. It's a special administrative region. It is by far the largest gaming market in the world, and Sands has by far the largest market share there. So the stock has traded poorly recently out of concerns regarding the Chinese economy. On top of that, they had all kinds of other problems where China just remained locked down due to COVID for much longer than the rest of the world did. And they were very slow in letting that economy reopen and letting tourism come back. I've been saying for the last couple of years that Macau will make a full recovery, and guess what? We are there now. Credit to Inside Asian Gaming, which is a fantastic publication. I recommend it for those of you who want to know more about the gigantic Asian casino gaming market. But last summer, the summer that we just concluded, Macau saw 6.7 million visitors. That is very close to the pre-COVID 2019 visitation of 7.2 million. The more important thing, Rob, is that August visitation was above 2019 levels. So you can say what you want about a weaker Chinese economy, but there are more people going to Macau now, going to Macau at this present time than there were in 2019. We're also seeing reports of very strong bookings for Golden Week, which is coming up next month.
Yeah, Gary, we know that there have been stocks traded down a bit with the weak Chinese economy. You, though, referenced the shareholder stock buybacks that were paid out, 550 million and 600 million. Other than obviously these good reporting numbers, visitation, it seems like that's the key piece that you're tying to still your bullish sentiment on the stock. Anything else of note?
Yeah, I think those three things are the key ones, Rob. The Marina Bay Sands in Singapore is now performing at record levels, record pre-COVID levels. Macau is now seeing visitation above 2019 levels and strong bookings for Golden Week. And then in the last 2 quarters, the company has returned almost $1.2 billion to shareholders through stock buybacks and dividends. They recently acquired a big chunk of Sands China, which is the company that owns a percentage of just the Macau assets. There's a lot going right at the company. I think the stock market isn't comfortable with it yet, but this is one of those things where gaming is one of those businesses that has been around for thousands of years. It has been a pastime all over the world, but in Asia in particular for thousands of years. I don't, I just see this as a company that is in the process of making a full recovery.
Gary, for thing number 4, we've seen quite a bit of talk on X and the finance community talking about the risk in Japanese government bonds, the carry trade. Thing number 4, a little bit of a victory lap, I'd say here, for better or worse, right? DKI called Japan's disaster in 2022. FinTwit now agrees. Thing number 4.
Yeah, so this is something that we've been seeing a lot of on FinTwit now. Everybody's now an expert on the carry trade, and they're all making the call. Fortunately, DKI was talking about this as early as October of 2022. So, 23 months ago. And we were out in public on it. Fortunately, there's video, there are time and date stamped videos, podcasts, a lot of writing. But basically, what happened was for years, the U.S. Treasury bonds were yielding a much higher rate than Japanese bonds, which actually were yielding a negative rate forever. The Bank of Japan they were even more crazy than the U.S. Federal Reserve. Our Federal Reserve kept our interest rates close to zero, but didn't control the 10-year as much. And so, we saw a lot of like 3 and 4%, 2, 3, 4% on the 10-year, where in Japan, they had negative rates and kept their 10-year below 1% forever. And so when that happened, we saw a lot of carry trade. And what that was people were shorting the yen and shorting Japanese government bonds, and at a very low rate or even a negative rate. And then they were using that money to buy the US dollar and to buy US treasuries. And that was called the carry trade. And as long as you didn't get too big a shift between the two currencies, it was kind of this risk-free transaction. And there were trillions, maybe even tens of trillions of dollars devoted to this. Well, the problem with that is, now the US Federal Reserve is going to be lowering rates. Japan is increasing rates. They're trapped. No matter what they do, they're kind of screwed. And the reason for that is because um, if the Bank of Japan keeps rates low, then they're going to have massive inflation. And the way you see that is the value of the Japanese currency has just plummeted against the dollar. Recently, it's come back a bit because Japan's gotten up off of zero. That's their version of the Fed funds rate, their reference rate. But with that said, um, part of the issue is Japan's debt to GDP is over 260%. So as they increase rates, it's going to create a massive deficit. And the only way they're going to be able to pay for that is to then print more yen, which leads to more inflation. No matter what they do, they're kind of stuck. If people remember from last month when the the Bank of Japan increased that reference rate, their version of the Fed funds rate, we saw the yen strengthen. And because the carry trade started to unwind, it caused a massive drop in the US stock market. We saw the S&P 500 and the NASDAQ in particular plummeting as a result of that. These were all things that DKI was talking about 2 years ago or 23 months ago. So we're glad to see that the FinTwit community is catching up, and we welcome people to this realization. And I'm not being sarcastic about that. It's important. This is a big deal. There's a lot of risk in the market. We're talking about tens of trillions of dollars lined up to move in the other direction when the US Federal Reserve starts to cut rates, and the Bank of Japan is talking openly about the need to raise rates again. So, should that happen and that carry trade starts to unwind, there's a lot of risk in both the stock and the bond market here. I think it's great that more people are starting to pay attention to that.
Yeah, Gary, you had it pegged. It was October 27th, 2022, calling it a death spiral. This is not going well if you're the Bank of Japan. So great job to you for being early and right on this, number one. Number two, anybody else that you'd like to call out that was on point with this call and seeing what you saw in the Bank of Japan?
Yeah, there were two other people who I think were early and right on the Bank of Japan and the carry trade. One was Michael Gayed from the Lead Lag Report and Title Financial. Michael was kind enough to host me on his show. It was a Twitter space at the time, and that interview is still up here on YouTube, and it still exists on Twitter, now X. But this is something that Michael was also early on and something that he's been covering in great depth and a lot of detail this year. So, thank you to Michael and congratulations to him for being right on this. Also, big round of applause to Mark Rosano. He and I got together. We spoke at the New York Alternative Investment Roundtable. I think it was in November of 22. Mark also understood what was happening very early. The two of us had, I think, an hour and 15-minute conversation focused on this. And, Mark's a really smart guy, like Michael. And I think the two of them, round of applause for being early and right on this one as well.
Thing number five, Gary, we're going to move to Nike. Stock has performed poorly for years, declining sales. Our friends over at Learn Wall Street, who I think you're going to talk about here in a little bit, put together some numbers and some data here. But thing number five, Gary, Nike, ticker NKE, stock tanks. Don't let the valuation fool you. And I think actually with Learn Wall Street, in our version of the five things, they talk about buying a company based off of past glory. You're going to talk a little bit about that.
Yeah. So, Rob, this is something, one of the things that I think is really important is investor education. Everybody, finances matter to almost everybody. Finances certainly matter to everybody who's listening to this show right now, and everybody who will, see the clips of this that Andrew puts up on X, on Twitter. And so what we want to do is help people learn and understand better. And one person who's done incredible work in this area is my old partner from Silver Arrow, Raji Kabaz. He started a company called Learn Wall Street, which is dedicated to helping novice investors and young people in particular learn about investing. And so, I don't have anything against Nike right now. There are some smart people, including Bill Ackman, who, think they've called the bottom and they're buying it. And I have no bone to pick with their analysis on it. But, Raji's point on Nike is that you really need to look at a company's history And that stock this year is down 24% to date and has really gone nowhere. It's gone down for the last 3 years. And, it would have been really easy at any point to say, well, the company is undervalued because the stock is down. And that's rough analysis. The reason the stock was down was because of relatively small declines in revenue. Revenue growth is really, really important. And, one of the things we talked about earlier in the show is how, Nvidia has had 100% or so revenue growth rates. And, Raji points out that on June 28th, 2023, Nike stock was down 20% in one day. And the reason for it was because they had projected a 5% sales decline. And so these things are really important. Companies that miss, companies that have slowing growth rates or negative growth rates, declining revenue, these things can persist for a long time. And when that happens, you can run the risk of saying, hey, the stock's a bargain because it's down. And Raji's point is no, it's not. It's down because the sales are declining. And that's the key analysis. Now, I haven't actually read, Bill Ackman's analysis on this. I suspect, he's not so much making a valuation play. I suspect he thinks the revenue growth will turn around. Again, if somebody has read his work on this, feel free to let me know. But that's a different bet. It's very different. If you're saying sales have been down, that's caused the stock to decline, but here's why I think sales are going to improve, then you have an investment thesis. You can invest in that. If it's just, well, the stock is down, so its proper value was its high point from where it was before, that's dangerous. And that's the point that Learn Wall Street is making. And that's a great lesson for all investors and to encapsulate it sort of in one sentence for people who are looking at this and looking at investing. If the stock is down off the highs, figure out the reason. Right?
Yeah, it's one of those. Or sorry, go ahead, Gary.
No. That's the key thing. The
Yeah,
market is wrong at times, but figure out the reason. Make sure you know what it is. And if that reason is declining sales, you better be quite certain that those sales aren't going to continue to decline.
yeah, definitely a situation here. Nike having a great brand for sure, but the stock no longer being a growth play. Question I wanted to ask Gary is, when choosing stocks, obviously a lot goes into the evaluation. What's another item out there for maybe beginner investors, intermediate, even in terms of something that you pay close attention to when picking stocks?
I think there's value in looking at the management team of these companies. A lot of credit to the DKI interns. Again, Andrew and Alex do phenomenal work. But they made a point of pointing out for this week's written version of the five things that Starbucks recently hired the CEO from Chipotle. And the reason for that is during his tenure at Chipotle, he more than doubled revenue growth. He grew the stock price more than 700%, and he dealt with the company's food safety issues. And so, the feeling was, hey, wait a minute, we've got a guy here who's proven himself. And, frequently you'll see anybody can have a hiccup, anyone can have a misstep, but frequently you'll see, people who are good tend to be good, and people who aren't so good tend to be not so good. And so I think there's value in taking a look at that. One of the things that we relied on, another one of our portfolio positions is AuthID, ticker AUID. They are, a micro cap public company in the biometric security space. But one of the things we looked at was the new CEO there, Ron DeGuro, had taken revenue at SoCure from a few million to over 100 million, signing, I think, more than 1,000 customers. So when you see a guy do that and he says, okay, I'm going to come into AuthID and here's my sales process and here's how we're going to build the pipeline, and I already know all these people in the technology and security space to reach out to, I think that's credible. And that's the kind of thing that we look at is, is that the whole story? No, but it should definitely be the kind of thing that you look at. Are these people executing? Do they have a history of executing, or a history that, maybe indicates they're not so terrific?
Great stuff, Gary. Once again, this is the AI chip issue, like we talked about at the top of the hour. Remember, please like, subscribe, follow us, a variety of different social media channels. Gary, you're becoming more and more micro famous
Right.
every single day. So, but YouTube, great place for obviously a video version of the 5 things. Subscribe to our free newsletter on the website, deepknowledgeinvesting.com. Be sure to follow Gary on X, Instagram. Maybe we'll eventually get him on TikTok. Not quite yet, but we're
Unlikely.
getting there. And thank you so much for all of your support. I know I have a great time hosting this show with you, Gary. Gary, any final closing thoughts?
Well, thanks, Rob. I know you've been traveling around. Always great having this hour with you. The other people I want to thank, first of all, to the people watching this, thank you. We know your time is valuable. We appreciate you spending it with us. We've had some really nice subscriber growth lately, and round of applause to the DKI interns, Andrew and Alex. Their contributions to this work are absolutely phenomenal. Their work and their efforts are directly related to the growth that this channel's had, to producing fantastic content that we're putting on X and on LinkedIn on a daily basis. It is remarkable work for a couple of college students who really understand investing, finance, economics, marketing. Guys, I'm really proud of you and thrilled to see the way you've developed and the great work you've done. And that's everything. Rob, any final words from you this time?
I don't think so. I'm thinking we got to keep no more weeks off. I think there's something to it. I think the 5 things is just moving the needle and keeping the pulse on the market for everybody out there.
All right. Thanks, Rob. Everyone, we'll see you next week.
Thanks so much.